to people who are in recovery to encourage them and promote healing. So pretty
it's
awesome.
It's a subscription service.
Yeah.
People can send it to whoever.
Yep.
So that's pretty cool. Jason Sherman from Instamore, then Bob Moule, who is the head of Artisan Mobile, and Bob Savino, who is the CTO of a new financial services startup called Movin'. Tomorrow and every Wednesday we have Night Owls, which is kind of open and free, and from 7 to 10 we've been doing that every week since January 2. And so feel free to come to that or share it. Both are free. We also offer co-working, so you can work here all day, all night, in the morning, whatever you want. You get a key, you pay us a nominal fee. It's kind of fun, and you get to hang out with people like Henry. He's the only notable person. Lots of other folks, and you're close to lots of coffee and food, so let me know if you have questions about that. And we're also running an incubator, and we're focused on what we call pre-early stage. And we've got 2 exciting companies in there, and we're always willing to share our insight into that process and talk about coming into the incubator. We have one interesting new program coming out really soon. It's called Office Hours, Walnut Street Labs Office Hours. We're doing it in conjunction with the Chester County Economic Development Council. Mary Fuchs is back there. So the CCEDC has not only supported us financially to fix up the place, it's also helping support live streaming and doing the video and going into the greater Chester County area and highlighting innovators with video. But they're also supporting this initiative called Office Hours, where senior or highly skilled folks from the area donate an hour or 2 of their time every week in 20-minute increments. And through our site, anybody can schedule 20 minutes. Here at the Evolve IP Incubator or the ICE Biotech Incubator at Eagle View, are they the same thing? Or on the phone. We really want to encourage people to come and meet in one of the spaces. What I've seen over the last couple of months is 15 minutes with the right person can save you loads of pain and anguish and money, and or taken the other way, accelerate success. So we think we have out of the gate 10, and when we're presenting it for the I2N, which is another regional accelerator, virtual accelerator, when we partner with them, we think we'll have over 50 people kind of offering insight and opinions and guidance. So we think it'll ignite innovation in the area. That's our goal. So thanks to CCEDC, thank you Fox Rothschild. Terry is here. Fox has been instrumental in keeping us from ending up in jail. As we innovate, you kind of break the rules, right? You need somebody over there to say, no, don't do that, do it this way. So we're on the straight and narrow. And who else am I missing? Third sponsor. Andrew Schwab, too, and our advisors, Grace Arnacki. Thanks to them. And all the regulars. So thanks for coming. This is a great presentation. Igniter TV, Sean Dominski working the live stream. All of our speakers, or 95% of them, are on Walnut Street Labs TV, our YouTube channel. In addition to all the vignettes that Mike shoots. So if you ever want to re-watch today's, or share today's presentation, you can share it. It'll be online immediately after you press stop. Yep. So Craig Schroeder, let's give him a round of applause for coming. This is Robin Adventures, and it's a great. It's surprising that we haven't had some official representation from angels or VCs to come in and talk and to give instruction on how. We've had a lot of entrepreneurs who have told us war stories or don't do this, do that. its content, and then we're going to do Q&A. So, last chance to run up and get coffee. Oh, I guess that's over. Craig, take the floor.
All right. Thank you, Chris. Good morning, everybody. You know, when Chris and I were talking about this morning presentation, this morning discussion, he said to me, keep your remarks short because the question and answer is the best part. And I said, okay, that makes sense. I always do better talking back and forth in a more conversational kind of way. And he said, no, that's exactly the kind of group we have here. Well, when I got here, I realized that this was not only a lot of very energetic, eager, talented entrepreneurs in the room, but we also had a lot of investors. We have someone from the Chester County Economic Development Council. We have a Wharton lecturer here. So there's a lot of people in this room that have an awful lot to add to this discussion. So I'm going to look at my role as being more of the facilitator of the discussion. I'm going to set up kind of the topic, which is funding your company's growth, and talk about the different stages of funding, and as the company grows, the different ways that you can get funding. And then we'll have a question and answer. And I really hope that people in the room who know more about certain aspects of this than I do will speak up and raise their hand and jump in on the discussion. Just so I can know who's in the room, how many people are currently either starting up a company or working in an entrepreneurial type of a company? A lot. Okay, great. How many people are active investors? All right, great. And we have economic development people and people from Wharton, so we are in shape for a great discussion today. So let me just get started. I'll give you a quick introduction to myself, about myself, what I've done. I was lucky to start my career for a very entrepreneurial, energetic company, MB&A, based out of Delaware. When I joined the company, it was 2,000 people working out of a former, it was a converted A&P supermarket that had been turned into office buildings, and down in Newark, Delaware, right near the University of Delaware. It was called Maryland Bank at the time because it was a subsidiary of MNC Bank out of Baltimore. And it had $5 billion in loans, mostly here in the Mid-Atlantic area. And I was there for 16 years, and this was a great introduction to me, for me, into the way the business world works. And we grew. It was a kind of company that there was a lot of energy, bringing in talented people, very collaborative, very fast pace of growth. And by the time I left in 2005, the company had grown to 120, it had grown to 25,000 people, and it had grown to $120 billion in outstanding loans. And now we were not only in the Mid-Atlantic, but also all throughout the United States and in 6 other countries. So it was a great chance for me to see kind of what a well-run company is like from the inside. So I left in 2005, and I loved MB&A, and I thought, if I'm going to leave there, I really should do something completely different. And my wife is an interior designer, and I've always had an interest in real estate, and we decided we were going to start a mom-and-pop business, buying older townhouses in established neighborhoods and fixing them up and renovating them, and then renting them out for a year or 2 years to people that were coming in from other countries to work in Delaware. Delaware, excuse me, has a lot of big corporations and also has a lot of people that come in from Europe or from other parts of the country to work for 2 or 3 years. And those people don't buy houses typically because they're only staying for a couple of years. And so we thought a townhouse might be a good fit. It's worked out pretty well. And then at the same time, so that's my first thing that I do. And my second thing that I do is Robinhood Ventures and early stage investing. I decided that I wanted to look at the growth of small companies, how they go and be able to participate in taking a company from the very early startup stage to the point where it's a successful ongoing business. And that's really what we're going to talk about today. So I don't have a clicker, so Ben, can we just go to the next slide? This is a very abstract look at the stages of the growth of a startup company. Obviously, there's a lot of detail that's missing from this because we want to keep it simple. This is how eventually you shoot up to extreme profitability and all become billionaires in the future. But in 1983, the Harvard Business Review published an article that became kind of a classic. It was the 5 stages of a company, the 5 stages of a company's growth. So I've looked at it from the same idea, inspired by that, looked at the different stages of funding a company. So these blue dots represent times when money might be coming in. And again, this is a very oversimplified picture, so we have something that we can be talking about. So you have the initial stage where you're first starting the company. At that point, your revenue is close to nothing because you have no company yet, and time is at the very beginning. Over time, you handle the startup aspects of your company, and you move to the stage where the company has the potential to be a successful business. So right about here is where an organization like Robinhood Ventures or early stage investing would get involved. Because no matter how well run the company is, no matter how much you're able to use the revenues that are coming in to increase the size of the business, at some point you need an infusion of cash from the outside. So in an ideal situation, and again, this is obviously the ideal, you would get an investment here, and your company would grow. You might get a second investment about 2/3 of the way through. Your company would grow, and it would get to the point where it is a successful business. It's successful, it's sustainable, and it's a company that will be able to continue for the long term. And at that point, you have to decide, okay, we got this great company here. How are we going to maximize its potential? How are we going to turn it from a company that does something really well to a company that can do something really well on a much broader stage, on a much broader level? So the example I might give, I know everyone is in probably very different businesses, but let's say you have a medical device, and you have something that you've been working with local doctors or surgeons to create this medical device. You create it, you get a patent on it, it's successful, you're selling it now, and you now sell it all throughout the Philadelphia area. You maybe expand your business down to Baltimore or up to New York, and you start to have this thing that's really terrific. It's making money, you're able to expand, you're able to produce it more at a higher scale. And then you say, okay, how am I going to make the most of this and have the maximizing potential aspect come in? Maybe you sell the company to Johnson & Johnson. It's a hypothetical. You sell the company to Johnson & Johnson. Well, unlike you, Johnson & Johnson has a worldwide network of distribution. And they already have customers all over the place that are interested in paying for their products in the medical field. So they're able to take your terrific product, and they're able to expand it and then take it from being a company that does really well on a local, regional, or smaller scale to the point where it's able to become a huge part of an even bigger business. So your involvement with the company, start here as a founder, go to this stage, and then there's kind of a handoff here where over time you give up control in exchange for money. So you think, well, this was my great product, and they say, we're going to take your great product, it's going to become our great product, and we're going to give you a huge pile of money, and you say, sounds great. And a lot of people that get into entrepreneurship do so because they love this stage, the stage of going from nothing to something. The stage of going from kind of a cool idea and a couple of guys sitting around or gals sitting around an incubator to the point that you actually have the business, you sell the product, and you say, you know, we've done this. We've turned this into something great. Then, are you going to be the same person that wants to figure out how to sell it in 18 countries around the world and how you're going to do the production? Maybe. But maybe you might say, I'm going to take my giant pile of cash that I've gotten from Johnson & Johnson, and I'm going to start my next big idea. So this is the kind of the different stages that I'd like to use as the standpoint for our discussion. Early stage investing, some people call it angel investing. I always feel a little uncomfortable with the term angel investing. It sounds like we're going to fly in from heaven and hand out some money. It came from the early days of Broadway, where someone was trying to get a play started or a musical started on Broadway, and they couldn't get the funding because those things are notoriously, or off-Broadway maybe, notoriously unsuccessful from time to time. And someone comes in and they say, we'll fund it. So someone just loves the theater and they write them a check. So the entrepreneurial community took that term, angel investing. I'm going to refer to it as early stage investing because I think that's a little more direct. Also, we should be clear that those of us that are investors typically are not doing this purely because we love to see the next generation of entrepreneurs succeed. That's one of the reasons. But we also would like to make money too. We'd like to get paid because we figure we're going to be investing in a company, and most of the companies we invest in do not succeed. And we'll talk about that a little bit later, the ratios, but most of the companies that start up either fail or kind of eke out a mildly successful. They don't have this trajectory. Now the good news is, and that sounds kind of discouraging, I don't want to be discouraging. The good news is that most people who have a failed company that have the potential to continue go on, start another company, and they say, oh yeah, remember back in 2014 I had that company that failed, but then that company I started in 2015 went on to go up like this, and it got bought by Microsoft, and now everything is good. So if your company runs into trouble, and if your company maybe even fails, remember that the next company is right around the corner. Okay, so let's talk about could we go to the next slide? I'm going to get rid of this kind of everything that happens after the startup phase. I'm going to talk about what is it that investors are looking for. I should tell you a little bit about Robinhood Ventures. Robinhood Ventures was started about 15 years ago in Philadelphia. It is one of the largest early stage investment firms in partnerships in the Philadelphia area. We invest in startup companies that are within an hour or two drive of Philadelphia. We want to be able to drive to the places where the companies are, see them, get to know them. Our goal is to have investors work with the entrepreneurs to build great companies. So we invest money, and the money is very important. We also want to make sure that we're not just giving money. So we make sure that the people who are our investors, almost all of whom are successful business people already at this point, are able to act as mentors, advisors, give direction, join the board of directors, and become a part of the growth and the success of that company as it moves from I left the shadow here so I can keep pointing to it, from here up to here, which is what you want to be doing. This point here, by the way, you probably, and again, I know there's a wide variety of different expertise in the room, so forgive me if I'm using terms that everybody knows already and explaining them like you're hearing them for the first time. I know you guys know what you're doing. The liquidity event is when you can take that investment that you've made as an investor and turn it liquid. So you invest in a company, it grows, it's super successful, it goes from being this little small startup to this big successful company, and you feel like, hey, my investment has grown to something. What's it actually grown to? You still don't have any extra cash in your pocket. And so what we refer to as a liquidity event is when you sell the company, either through an IPO or much more likely as being bought out by a larger company, and the founding partners, the entrepreneurs, as well as the investors are able to take their money out of the company and have liquidity and use that money then for the next thing. So how many people have applied for or are in the stages of applying for funding from an early stage investor? Okay, good. So you guys tell me if I'm doing this right. I'll tell you from my perspective, and please feel free to raise your hand and jump in. So what do investors look for? All right, the first thing we're going to look for is a must-have product. So must-have as opposed to nice-to-have. You want a product that people are like, oh my gosh, I have to have that, in whatever reason. Now maybe it's a business-to-business product where people say, I can increase my sales by X amount. Or maybe it's a consumer product where people are like, I really need this thing. I can really use this. Maybe it's a product that they don't even know that they need yet. Apple Computer is famous for saying, we create products people don't even know that they need until they come out. And if you can pull that off, that is incredible. That's why they're incredible. Most often, it's something where it solves some kind of a problem for your customers. They call it a pain point sometimes. There's a problem, and you have to figure out, how does my product or my service solve this problem? If it's a nice-to-have product, it's kind of like, oh, yeah, sure, that would be good. That'd be cool. That's not as good. Because then it becomes more optional. Then it becomes more, I'll get it if I don't have anything better going on. So a must-have product. Second of all, a competitive advantage. In any business, especially a successful business, there's going to be there's going to be other competitors that come around. If you're in a business that you have no competitors, you're either way ahead of the curve or you're in a business that everyone else has figured out that nobody wants. So you got to figure out which one that is. But typically, you're going to have competitors. And that's OK. Having competitors, having aggressive competitors, having big competitors, that means you're doing something right. That means you're going after a market that people really care about. So don't worry if you have competitors. The question is, do you have some kind of an advantage over your competitors? So one of the things when you come in and present to us and talk to us about your company, we're going to say, tell us your top 3 or 4 competitors. and tell us how your product or service, and I'll use those terms interchangeably, how your product stacks up compared to those of your competitors. Are you going after a somewhat different market? Or does your product solve their problem in a more elegant way? Or is it more compelling somehow? So you just need to know, don't worry about the fact that you have competitors, but you need to know that your competitors, that you have some kind of an advantage over the products offered by your competitors. Next, a substantial market. When you're in this early stage, one of the great things about being kind of right here, where you're thinking about your great idea, is trying to figure out specifically what your market niche is. Who are the people that are going to buy your product? And you start out as broad as possible. Well, this is a product everybody's going to want. Well, no, it's not. There's no product that everyone's going to want. So then you narrow it down a little bit. Okay, well, this is a product that people in this situation are going to want. And then you think about, all right, out of all the people in this situation, can everybody afford to pay for your product? Is everybody, as invested in this problem that you're trying to solve as everybody else? And eventually, as you start narrowing it down, you're going to get down to a very specific niche, a very specific group of people that are going to be your most eager, your most enthusiastic potential customers. And you want to talk to those people. You want to figure out, what exactly do you need? What is the problem we're trying to solve here? What's the need that we're trying to fulfill? So once you have that product, you need to figure out, how big is that market? If you have a great product that's able to just blow away all the competitors, but the market is so small that even in the very best case, you're not going to be able to make any money, then you don't really have anything to build a business on. And on the other side of things, if you have some huge potential market, you need to think about, hey, that's great, right? That's a great problem to have. You need to think about, how are you going to get your product out from wherever you are to millions or potentially billions of people that might want to buy or use whatever it is that you have to offer. So we want to see that your market is substantial. Next thing, how are you going to protect your market share? Anything that's good is going to have other companies come along and try to take your market share. It's just the nature of being in a free market. It's the nature of creative destruction. People are going to come along and say, hey, this is terrific. I have one that's a little bit better. Or I have one that's almost as good, and it's 20% cheaper. And so how are you going to protect yourself against that? How are you going to protect yourself against larger players that are going to be like, oh, here's this two-person business operating out of Chester County. Well, we're a huge multinational, and we're going to make a knockoff version of that product, and we're going to sell it worldwide, and that's going to be the end of their business. That's the way it works. So you need to think about that. There's two ways to do it. One is if you have something that is protectable intellectual property. If you have something that you can copyright, something that you can patent, something that you can say, I have legal protection because I am the inventor of something. And you could be the inventor of a process. You could be the inventor of some physical device. You could be the inventor of whatever it is that makes your company special and your product special. You need to register that, and you need to make sure that you can get that patent protection in place. And there are patent attorneys who can get that process started for you for a relatively low fee. So that's one way. Intellectual property, something unique that you have that can be legally protected. But maybe you don't. Maybe there's not some great invention. Maybe it's just the fact that you're going to get out there and do this thing that no one's doing right now. All right, in that case, you need to have critical mass. You need to get as big as possible, as quickly as possible. Sometimes they call it a land grab, right? They say, the land grab, the border of Oklahoma is about to open up, and tomorrow morning everyone can go in, and whatever land you can put a stake around, you can have that as your ranch. It's a land grab. So in that case, you know that your product, once you announce that this thing is available, everyone's going to want it. You need to get as many customers lined up so you can establish yourself as the key player in this market. And if you think about some of the products that are out there, there's a lot of things that are not really all that protectable, that the companies are successful because we all know that that's who we want to go with because that's where everyone else is, or that's what we're used to. Twitter is an example of that. Microsoft, a lot of Microsoft's products are examples of that. And there's plenty of things like that. Any restaurant in town is an example of that. There's plenty of things that someone else could do it, but once you get there and become established, you're able to protect the market that way. All right, your fifth challenge in this early startup stage before you come to talk to investors is creating a prototype. Again, you could have a prototype of a service or a prototype of a product. Prototype does not need to be everything is perfect before you go show it to investors. A prototype means you need to have some kind of a proof of concept that this thing you're trying to do will actually work. If it's a physical thing, maybe it's held together with duct tape and crazy glue, and it looks like something out of some sort of weird Rube Goldberg lab. That's fine. As long as you can say, hey, look, here's this thing. It does such and such. It's not too pretty to look at, but once we are able to produce it at scale, it's going to be really elegant and really awesome. That's what you want. Same thing with service. You could have a computer program. You could have a service that doesn't really work 100% yet, that is able to only do 60, 70% of what it eventually will be able to do. That you get to some pages on the website and it just says, come back when we finish this in the future. That's okay. You want to have something that shows this is what we're going to do, and we have some kind of confidence that we can make it work because we've tried and we have the startup version. Along the same lines, you want to have some kind of initial customers. So you create this prototype, and then you go out to your target market. Again, you're trying to really narrow that target market so that you have your initial group of people that are going to be the most enthusiastic, the most passionate about this thing. You find them, you tailor it for them. Over time, if you're successful, more people will find out about it, and there'll be additional people outside of that very narrow segment that want to buy this also. But you start out with the people that need it the most. You go out to them and you say, and you bring in this thing with the duct tape, and you kind of put it down on their table, and you say, this is going to solve your problem. We want you to try this for 60 days and tell us what you think. So you can think of them as beta testers. You can think of them as someone who is able to give you some feedback. You would love if they actually are willing to pay you for the product. Sometimes they are, sometimes they're not. But if they're not paying you in cash, but they want to pay you in advice and feedback and follow-up focus groups to figure out how to refine your product and make it better, in some cases that's worth even more than cash. As investors, we want to know that you've gone out to your target market, that they're working with it, and then we're probably going to want to, at some point, talk to the people that have actually used the product and say, hey, you tried this for 60 days. Did it seem to solve your problems? If this was available starting in October at a cost of $60 a month, would you be willing to pay $60 a month for something like this? And if they say, absolutely, I could use like 100 of them, I'll buy as many of them as they have, that's a great sign. If they say, yeah, it was a little bit rough, but I think once it gets, give them some feedback, and once it gets refined, I'd love to buy it, that's also a good sign. So working prototype and initial customers who try out the prototype and give you feedback. A detailed business plan. I bet you hear about that a lot in this room. Sometimes as an entrepreneur, as entrepreneurs, we say to ourselves, I know this product better than anybody else. I know my business. I can manage this. Any problems come along, call me. I've got my phone in my pocket. I'll resolve all the problems. And we're just going to run this thing by the seat of our pants. That's great when you're kind of here. As a matter of fact, it's almost mandatory when you're kind of here, because any plan that you come up with is going to be too sketchy, too incomplete at those early stages. By the time you get to the point you want to explain your business to somebody else, they don't know you the way you know yourself. They don't have the kind of confidence in you that you have in yourself. And you are also basically saying to them, I'm not just good enough to run this company during the startup phase where we're working out of an incubator on Walnut Street. I want to get to the point where this is a successful business that's going to employ people, that's going to have hundreds or thousands of customers, and we're eventually going to sell this company to a large corporation. We're going to become so integral to what this particular market is that we're going to sell this to someone who says our business plan can't succeed without this person's company. So how are you going to do that? And that's the question, and that's the importance of the business plan. Now, the business plan's a big pain in the neck to fill out, because you're starting from here and you have to make some wild assumptions about what's life going to be like when you have more than 2 people, 3 people, 4 people working for the company. What's life going to be like 2, 3 years out in the future? So there's a lot of assumptions, predictions, projections that have to take place. Everybody understands that these are projections. Nobody is going to come back to you and say, hey, you promised back in 2014 that you were going to do this, and now it's 2017, and you changed your strategy, and you went after a slightly different market, and therefore, it's all off. People understand that things are going to change. As a matter of fact, I would venture to say that there's never been a business plan that was created at this stage of a company's growth that ever ended up getting executed exactly the way people thought it would back in those days. So put something together that is your best estimate of how things are going to go. Not your best case scenario about how it's going to be wildly successful. Not the super conservative where you assume that, worst case scenario. Something that you think is the most likely path you're going to take. What we're really looking for at this stage are the ideas that you have and the strategies you have about the markets you're going to go after, the customers you're going to be trying to support, the people, the growth, the way that your revenue is going to support your cash position. As you change it, keep in contact with your investors. It's not if you change it, you're going to change it. So take the time to do this and do it right. It's your first introduction to investors, and it's your first way for investors to really get a sense of how serious are you about this. I should say one other thing at this point that investors think about an awful lot, which is that there's a lot of people who have great ideas. You probably say to someone, oh, I'm an entrepreneur, and someone will say, oh, I saw this on Shark Tank, or my grandmother came up with this idea about this thing. Oh, really, what happened? Well, she never did anything about it. There's so many people that have great ideas that can't execute those great ideas. And so when we hear about a great idea, when we hear about a market that's terrific, we say to ourselves, okay, great, that's a good start. But that's only half of the picture. The other half of the picture is how well can you actually turn that idea into something that's going to be a successful, sustainable business. And that's what the business plan is going to tell you. In addition to being a guideline for you and how you're going to run your business, it's also a guideline for the investors about the kind of entrepreneur that you are. Are you someone who comes up with all these wild ideas and isn't able to make them happen? Or are you someone who says, yeah, I've got some good ideas. Yeah, I'm a little outside of the box sometimes. That's great. But I'm also someone who's methodical enough to be able to put together a plan and actually make something happen. And business plan really goes a long way to explaining your execution. How am I doing on time?
We're kind of pushing it. Can we kind of maybe cover the rest of that maybe through a Q&A?
Sure.
If there's some steps.
Absolutely.
On that bulleted list that you have questions?
Why don't I do this? Why don't I go through the last 5 things in 60 seconds and get them out of the way, and then with the ones you want to talk about in more detail, we can talk about in more detail. These are the easy ones. I put the quicker ones at the end here. So you want a company that has rapid growth potential. You want, as far as talented managers, one way to think about your management team is you want someone who understands the technical aspects of the business, and you want someone who understands how to run a business. Now, it'd be great if that was the same person, but sometimes you find that one person naturally goes into the role of the technical person, the other person goes into the business person. If you have a third person, someone who's great at sales and marketing. If you have a fourth person, someone who's great at production. Reasonable valuation. We can talk about that in the Q&A. Typical valuation for new companies in the United States is about $2 million. If you include the ones that are being financed out of Silicon Valley, it goes up to 2.5, 2.7 million. But around here, typically, you see a $2 million valuation. And that has a big impact later on in your relationship with investors, and I'd be happy to talk about that in more detail. Your investor's going to want to participate in your board, going to want to be part of the company all the way through all the stages. And we want to make sure the company is exit-focused. We want to make sure the company is not just being built because it's such a cool idea, because you want to have a great lifestyle of running a company. That's great, but if you are trying to get the kind of investors who want to come in at this stage and then sell at that stage, we need to know that there is going to be at some point a big company that's going to come in and buy this thing. And the sooner that you can focus on that, the better. That's not the only business model that works is of an exit-focused company. Sometimes companies are not, but it's the only model that's going to attract serious investors. Next slide I will skip, but the next slide is this. Well, could you go back to it, though, just so I can say what it is? Sorry. This is a process for what you do. I'll come back to this, or I can talk with you about it later. But this is a process of if you go to a early stage investment group and you're looking for funding, the various steps you need to go through from applying all the way through presenting, having us do a due diligence review of your company, making a funding decision, being a part of the company all the way until the liquidity event, and then finally and occasionally follow-on funding, which happens more and more these days, and the liquidity event. And Ben, if you'll switch back to, yeah, why don't we leave it on? We'll go back one more.
Okay.
All right. And at that point, I'll ask Chris to come back up and answer any questions. Thank you.
So house rules, just introduce yourself, clearly tell us your name and what you do and then answer your question.
David Jopko, I'm an investment banker. Question for you. We can drill down right to Robinhood so the group knows what Robinhood's doing at the moment, which is, what's the average investment Robinhood is making right now in your firm? Realistically, from the time that somebody starts talking to you to the time they get funding, about how much time are we looking at? Does Robinhood have a template they'd like people to use for the business plan? Are you still funding any pre-revenue, pre-positive cash flow, something like that? Are we looking at lots of individual investors coming in, or can we pool investors so that Robinhood, we don't have to deal with individual investors? And when you talk finally about substantial market, how big a substantial market would Robinhood be looking at?
Yeah, great questions. I've memorized all those questions. I'll be answering them one by one. Could we go? Yes. Could we go back to the how the investment process works? The one two after this. So to answer your questions, the typical investment is the typical investment that early stage investors make in a company is about $1 million. And that's usually not one group of early stage investors. That's usually what we call syndication. Several early stage investors working together, collaborating on due diligence, and each group, in the case of Robinhood, let's say Robinhood kicks in $300,000. Someone else invests $100,000, someone else invests $400,000. We get into that range. Sometimes, obviously, that's an average. But typically, Robinhood Ventures would invest between $250,000 and $500,000 in a company. So the valuation is typically $2 million. Again, we're talking round numbers here. Everything's a little bit different in every unique situation. But if you start with a $2 million company, pre-investment, pre-money valuation, then you invest $1 million. Now the new valuation is $3 million, and the investors own a third of the company.
Okay, follow up on that. Will Robinhood help people, if we come in and present to Robinhood, will Robinhood help us find the next $500,000 or $600,000 beyond what you guys are putting in?
Yeah, absolutely. Okay. We have more and more been syndicating deals. So we hear about a good company. We'll say, hey, well, let me tell you real quick about how, because there's a few questions I wanted to get to here. If you look at the process, let's say we start in September and you submit an application online. In answer to your question, there is a specific template that we use. It's on our website, robinhoodventures.com. So you submit your application, you submit your business plan. You probably have a little slide deck that you're going to want to submit as well. And we're going to take a look at the application. If it fits the kind of thing that we do, we think it has some potential, it's going to go in front of our screening committee. And it's going to then eventually, if it makes it through that, if people are really excited about it, we'll invite you in to present. So let's say you present in October. Everyone loves it after that. We do our due diligence for a few months. We could have a funding decision for you by the beginning of the year. Now, we try to be very cognizant of the company's own timing as well. So if you have something where you have to get funding by December, or else there's some big problem, or there's some big opportunity that you can take advantage of if you get funding earlier rather than later, obviously we'll work with you on that. But to think in terms of 2-3 months is probably not too unreasonable. As far as syndicating deals, it's become very, very common in the early stage investing community that there's this group over there that invests, another group invests, and we collaborate. We also, as we get to know each other better, as the various investors get to know each other better, we collaborate on due diligence. So we'll say, hey, we are working on looking at a company, and the Mid-Atlantic Angels have looked at that company, or the New York Angels have looked at that company. We're going to make use of their due diligence, or reverse, they'll make use of our due diligence to be able to be a little more efficient and save some time. Let's see, other questions. How do we come in with a bunch of checks or one big check? Every company is a little bit different. Every investing group is a little bit different as well. And the way we do it, we feel is the best way for the investor, which is this. Every partner in Robinhood Ventures makes their own decision about how much they're going to invest. We literally go around the table after the due diligence is complete, after the recommendations have been made, and we say, okay, Chris, how much are you going to invest? Ben, how much are you in for? Lynn, how much are you going to invest? And someone says, all right, I'll invest $10,000, I'll invest $25,000, I'll invest $50,000. And they make these personal commitments based on their own investing goals, based on their own personal assessment of the company. And then we combine that all. So let's say that all adds up to $300,000. So we go back to you as the entrepreneur and say, hey, congratulations, there's a lot of interest in the room. We can give you a tentative commitment of $300,000 worth of an investment. Once we do that, we then create a limited partnership so that you get one check and you have one person to deal with. So our big 30-some person group is not a bunch of investors contacting you all over the place. We don't want to bug you too much while you're trying to actually run the business. We understand that running a business is tough enough without having a lot of distractions and questions and requests for information and so forth. So we appoint one person. Whoever's the most knowledgeable and excited about your company within our group is going to be the lead investor, is going to represent our group, and is probably going to be the person who joins your board. And then you're going to see them at every board meeting, so they're going to be involved. You're not going to see the rest of us, because we're going to call on that person to say, hey, if anything's going on with this company, explain it to us, let us know, give us some updates. If not, you're managing that. And we all pick companies that we feel really enthusiastic about to represent.
Most importantly, do you invest in pre-revenue?
We do invest in pre-revenue. We would like to see some revenue. We would like to see customers, paying customers, but we are willing to, from time to time, go into an earlier, more seed stage if the company warrants it.
So what would that look like? I'm
Sure.
sorry. Yeah, my name's Dan Lawson, local aspiring entrepreneur in tech. And just as far as kind of to piggyback off the pre-revenue question, sometimes in order to get a prototype off the ground and establish a customer base, it requires a substantial amount of initial investment just in development.
Sure.
So how do you evaluate a startup kind of pre-development for that matter? I mean, what do you look like to value a company kind of that stage?
Right. No, that's a great question. How do we figure out how to value a pre-revenue company? Basically, when we talked about the list of things we look for, we want to have as many of the things on that list as possible. The more, the better. So in the case of software, a lot of times people will spend a lot of time coding and preparing the software and finding customers, and they'll do that for free. They'll do that based on the hope and the expectation that someday when the company sells, they will be, as a founding member, able to participate in the equity benefit of that. So that's the most typical thing in a software kind of a situation. We would expect to see something more than just a great idea, obviously. But we do not expect to have something that's shrink-wrapped and ready to ship out to the public. We have people who have technology. That's another thing I didn't get a chance to mention, but we have people with a wide range of interests and a wide range of backgrounds. So we would have one of our technology folks sit down with you and say, tell me what you have so far, show me your prototype. I mean, any software company is going to have some kind of a prototype that they're working on. We don't expect it to be perfect. We don't expect it to be even to the point of being finished, but we do expect it, if we're going to invest in a company that does not have a working prototype and doesn't have customers yet, we're going to expect that the other areas on that checklist are very strong. By the way, if anyone would like a copy of that presentation, talk to me or to Chris, and we can make sure that slide, the checklist, or this slide here, we can get that to you. Did that answer your question?
Yes. Yeah, thank you.
Oh, sorry.
I have a question.
Yes, sir.
My name is Lars Knudsen. We have an early stage biotech here in Westchester. We have a pharmacological treatment for snoring, which is an over-the-counter drug with market potential into the billions.
Right.
Because there's no.
Sure.
Anyway, it's the nature of the business plan. So we talked to Brenda Gavin of Quaker Bio, and she said people don't have the patience to read a long Word document. So would people be happy with a PowerPoint with detailed financial projections, or do people demand a Word document these days?
I think that people will start with your PowerPoint, with your deck, as they say.
Yeah.
And I think that that's our first introduction to the company. That's your chance to really lay out what it is that's special about your product, what is special about your approach to solving the problem, and give an overview. But yes, there are absolutely many of us that want to go through the Excel spreadsheets in some detail to look at your financial projection, to look at where all your sources of revenue and all your expenses and how that's going to grow over time. As far as a Word document, yeah, we'll need to see some paragraphs about especially when you start talking about competition, when you start talking about what makes your company unique, when you're talking about bios of the founding managers. I would say that you still do need to have some words around the numbers.
Lars, it's great to meet you. Maybe we can get you back here to take the
Yes,
stage.
you're very happy.
Okay. Great. There's one behind the pillar.
Yes, sir. Just to kind of follow up on that, one of the things I advise people to do.
Right. Just intro yourself.
Ray Sarnacki, I'm an advisor here at the labs, and I also teach at work part-time. One of the things I've advised people to do is to have two decks. One is one that you present, and another one is one that has more detail that you can use either as a leave behind or as an introduction in lieu of a Word document. I found that that's actually helpful.
Absolutely. And a lot of times we get presentations, people come in for presentations, and they have 20 different extra slides in the appendix, and they say, well, now that you mentioned that in the question and answer, let me just flip to this thing that explains that in more detail. That's great advice. This gentleman over here has been waiting. Yes?
Hi, Frank. My name is Andrew Schwab. I'm an advisor in the lab, also a serial entrepreneur in tech. My question to you is, how do you deal whenever you've done an investment in a smaller stage company and you start to feel like geographically they might need to, I don't know, maybe open a presence on the West Coast or kind of relocate to take better advantage of a market? How does that fit into the plan with Robinhood Ventures? You know, what are the indicators? Anything you want to share about that?
I think that for us, this is just for us, everybody's different. There's an awful lot of people who are willing to invest in companies that they can't physically go visit very easily. For us, we'd like to be able to drive to the headquarters. We'd like to be able to drive to talk to the people that are in charge, and we'd like to kind of, you know, for board meetings especially, to go into the offices, to be around and find out. There's something that you can, as you I'm sure well know, there's something that you can get from being there and being in person that you can't get over a Skype or whatever. If the company says, hey, we're going to be based out of the Philadelphia area, but we need to open an office in Austin, or we need to open an office in San Francisco or in San Jose or something, absolutely. That's completely fine. But for us, and only for us, it may be different for others, it doesn't work for us if the headquarters is not within a short drive of the Philadelphia area. And we look for companies that have made the commitment to this area, just because I didn't get a chance to talk too much about investors' motivations, but we do want to make money, but we also like to see the next generation of entrepreneurs succeed, and we also like to see our own area here in Greater Philadelphia continue to succeed and have a lot of energy, entrepreneurs, and entrepreneurism, and new jobs being created.
Awesome. Wes?
Wes Garnett. How to start up. Wondering what your advice would be in terms of explaining market potential to an investor if you're starting in a niche market because there's less competition there. It seems like I always get the same question, why are you starting so small? But we're starting small for very, very specific reasons that we believe will give us a competitive advantage in the long term. But it seems to sort of deflate the conversation and interest seems to be lost when we sort of explain that we're starting in a niche market. So I'm wondering what your advice would be.
My advice would be that there are, to think about what we talked earlier about in terms of the people that are going to be buying the product at first versus the people that are going to be buying the product once it grows to its full potential. We all know that this, with any product, there's going to be a niche market, but the people are going to be the most passionate about it. The people that, maybe it's something where the people aren't, people outside of a small niche don't even understand what it is, or don't even have any interest in it whatsoever, until you actually get the product up and running, and then you're going to want to show that at some point you can sell this product to something beyond this niche market. Unless the niche market provides the kind of returns, the kind of margins where you can actually build a successful business only in this niche. That happens sometimes. I mean, there are companies that sell specifically to very wealthy clients, or to people who have a lot of disposable income, or people who are specializing in something specific where they're willing to spend a huge amount of money for the right tool or the right piece of equipment or the right whatever it is because it's so important to them. Typically, you'd want to be able to show that you're going to start very targeted, very small, very niche, and then over time it's going to spread out to a much wider group. Does that answer your question?
Yeah.
Okay.
Danny?
Hey, how you doing? I'm Danny Grant. I'm a mobile product manager at a startup called Meetup. I'll tell you guys more about it afterwards if we have time. My question for you is about the failures that you mentioned. So I'm paraphrasing, I think you said many or a lot of startups fail.
Sure.
I wonder if you could just tell us what the top 3 reasons are, and then maybe what is a scenario look like where a company failed well versus failed poorly, and
Sure.
did it become a springboard or not?
Yeah, no, that's a great question. There's one thing that eclipses everything else in failure of a startup company, and that is cash flow. A lot of times, this is the number one thing that you have to watch out for in terms of, is your company going to succeed or fail in those very early stages? Do you have enough money to pay the bills for another month or another week or another day until the next check comes in from one of your customers? And so when we see a company fail, that's far and away the most common reason. I was reading a biography of the guy who started Under Armour, Baltimore guy, and he was he was selling initially to university sports teams, and he was working with the universities and he's hanging out with the players and the coaches in the locker rooms, talking about what do you need in terms of athletic apparel. And he thought, correctly as it turned out, that if you could get these universities, he couldn't afford like the NFL, NBA, Major League Baseball guys to wear, but he said maybe I can get some guy from the University of Oregon or someplace like that to wear this stuff, and then it'll gradually catch on. So his strategy was great. The problem was there was enough of a lead time that he has to produce these clothes, and then he has to deliver them, and then they're going to pay for them. And the universities would either send a check or not send a check. And he got down to his very last, his very last dollar in his account, whatever it was, I think $1,000 in his account. And he said, if I don't get this, if I don't figure out a way to turn this $1,000 or whatever it was into a larger amount of money, I'm not going to be able to pay anyone who works here. I'm not going to be able to pay for the clothes when they come in from wherever they're being produced. I'm not going to be able to pay for the materials, any of that stuff. And he went to Atlantic City and gambled the last $1,000, and he lost. This is where you expect him to say, hey, you won, it all turned out great. He lost, and he drove back to Baltimore in tears, literally in tears. And he gets home, he's like, I guess that's it. I guess Under Armour is just going to be one of those kind of cool failures that we tried, it didn't work out. And so he got back to his house, and he's kind of thinking about his failure as an entrepreneur. And the next morning, a check came in from the University of Oregon, I believe it was. And they said, hey, we love your stuff, and here's $10,000. And that was enough to kind of get things back going again. So cash flow is absolutely the most challenging thing. It's the number one reason. You may have other issues. And by the way, on cash flow, the challenge is to try to figure out a customer that's going to be able to pay you on a recurring basis so that you have some kind of predictable revenue coming in. If it's one customer who just loves your product, that you can sign them up to, at least I know every week I'm going to get my $200 from this customer or whatever it is, that goes a long way. Some kind of stability. And you don't have the stability in those early months and early years, so you really have to watch out for that. Other things are mostly related to execution. You occasionally have investors that argue with, not investors, you occasionally have partners that argue with each other or have a different vision for the company. You occasionally have, the world changed kind of things where you thought it was going to be like this, and then suddenly a recession breaks out, or suddenly someone comes out with a product that you weren't expecting. That I would say probably the best kind of a failure was when you did everything right, you executed right, and then like Google bundled something for free in their next product that was the thing that you were trying to sell. And you're like, well, what the hell are you going to do? So.
I have a question from Twitter.
I think we have, let's take Twitter and...
Which reminds me, we need to announce that in the beginning that we'll be taking live tweets.
I'm going to tweet my response, so it'll be very silent here and awkward for a couple minutes.
Excellent. And hopefully, you know, he's watching the stream, so I'm assuming he is. This is coming from Doug McConaughey. He's an advisor to the lab. But he said, do you think a successful 20-year-old internet company who has yet to reach its potential is of interest to investors, or is it too old to be successful on a large stage?
All right. Good question. No, you're never too old to be successful on a large stage. So, Doug, if you can see me there, the determinants of success for an older company are going to be the same as the determinants of success for a younger company. And that is, are you able to come up with something that is compelling, that can reach a group of people that are going to feel passionately about your product? And if so, are you able to execute the growth of the company? Now, obviously, you're going to have to prepare for the question of, well, what you've been doing for the past 20 years. You know, if this was so great, how come it didn't succeed 10 years ago or 15 years ago? And probably, if you have a really good product or service, the answer is going to be something's changed. The world wasn't ready for this back in 1994. Was it 20 years ago? Boy, the world wasn't ready for it back in those days. And now, the technology is better, and now we're prepared to offer this thing. I heard a story about Steve Jobs in the 80s giving a presentation at a convention in, I think it was in Aspen, and he was talking about his idea for the future. And he said, this was 1983 or something, 84, and he said, in the future, people are going to walk around with books that are going to be electronic books. They're going to be the size of like a normal book that you carry around, but they're going to be connected by like walkie-talkie radio signals to all these other books. Are going to be connected. And then cars are going to drive down the street and take pictures of every business, of every road, and you're going to be able to look at your book as you walk down the street of Aspen, and you're going to be able to actually see the different stores, and there's going to be the ability to communicate with other people. You're going to be able to write letters to people on these books. These books are going to, and he was talking about the iPad, but it didn't exist because it couldn't exist. There was no technology, there was no computing power, there was no battery power, there was no screen. It just wasn't. It worked out great as a kind of a science fiction thing, but it took until just recently to be able to actually have the technology come together. So I would hope that your company is the next iPad or the next Apple computer, and hopefully, despite having worked at it for 20 years, there's something that's going to really change things in the future, because we're always willing to listen to good ideas.
All right, I'm going to ask you the first question after we wrap up, and that's going to be what trend are you seeing of the companies that are applying? So if you want to hear the answer to that, come on up.
Oh, teaser. This is
let's,
great.
well, we got to stand firm on 10 o'clock, so let's give Craig a round of applause.
Thank you.